Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Are you a short-term trader in that the old saying exists, the stock market takes the escalator up and the elevator down, meaning it creeps up slowly, but then when it's time for the bottom to fall out, it just falls out and goes boom, so to speak. Going boom. I have a 2-year-old at home, so forgive my 2-year-old analogy with that. But with that being said, as a short-term trader, you're looking at the market from the standpoint of the market can go up or it can go down. You have that shorter-term uncertainty. With that, I also ask the question, are you too uncertain to venture into the market? Do you have that feeling that, well, maybe the market's going to go down a little bit in the near term, but I really don't feel comfortable fighting that long-term bull, but my indicators are telling me that the market's going to go down, and I just have that feeling. Is that you? And if it is, there are alternatives of other things to trade that don't correlate to the stock market. Now, here's another question. Are you diversified? Now, what this is a chart of SPY, which is the S&P 500 ETF. The spiders, when you buy SPY, you're essentially buying the market, so to speak. You're buying the S&P 500. It correlates to the S&P 500 index. IWM, which correlates to the Russell, and MDY, which correlates to the mid caps. So with that, I want you to look at this chart, and let's say you're thinking, okay, I want to be diversified. I want to put a third of my portfolio in large caps, third of my portfolio in mid caps, third of my portfolio into the small caps. Folks, this is a 2-year chart of how they actually perform. Now, of course, there's some variances along the way, but the point with which I'd like to make is that I'm not against diversification by any means, but I do believe in true diversification, which we'll discuss in a little while. To me, this looks like a lot of things are going in the same direction in a lot of ways. Of course, you see the variances in there to where certain things outperform, but throughout time, you see plenty of areas where all three lines are touching each other, so to speak. So over time, I'm of the belief that the market kind of tracks itself. And with that, there's always the argument that maybe the small caps outperform the large caps because there's a little bit more of a risk factor involved with the startup companies. You have that, but the bottom line, when you look at this, you're going to get a similar movement from all three of these major indices. Now, what about the sectors? Which sector is going to perform well? Is it going to be energy? Is it going to be healthcare? Is it going to be the materials, technology, utilities, financials? Which one is going to do the best? Now, what we have up on the chart here, these are the 9 SPY, these are the 9 Spider Select sectors. These are the ETFs, and with that, these represent the S&P 500, the different sectors. Now, some sectors are more highly weighted than others, but with this, even when you sectorize things, you're still getting a lot of similar movement. Now, of course, recently over the last 2 years, you see the financials that are definitely a lot lower than the rest of the pack. But my point is that the movement is, you're not seeing any crisscrosses. A lot of ways it moves in the same way, and you make the argument that over time, you're going in the same direction. And if you were to do this, does this mean that you're diversified still? I say that yes, you're diversified to a point from the point of the sectors. So with that being said, if you diversify based upon size of your stocks, whether they're large cap, mid cap, or small cap, as well as sectors, does that make you truly diversified? I don't think you really are truly diversified based upon just that alone. With that being said, I do have people in these Spider Select ETFs that I'm mentioning, so I'm not trying to bash that strategy by any means, but what I'm saying is that that's just part of the picture. Let's go overseas. Let's say that we want exposure to the overseas markets. Things are going well in Japan and Britain. Let's take a look at some of them. What you're looking at right here is an ETF based upon the Japan index as well as the United Kingdom, and compared to SPY. Now, sorry about that, folks. With that, you're still seeing things going in a similar direction, and all of these charts are based upon approximately the last 2 years. So with that being said, you're still moving in a lot of the same directions. Where are you going with this, Mike? Here's where I'm going with it. We believe there's a need for investors and traders to have currency exposure in the long-term portfolio as well as the short-term portfolio. Now, on the long-term side of it, let's say that you do have an opinion on the yen, the euro, the Swiss franc, the Aussie dollar, the loonie, whatever. If you have an opinion on it, we believe that there's no rule that says you're not allowed to trade that portfolio with your long-term money, so long as it is a smaller portion of it, so to speak. By having exposure to currencies, you can put your opinion in whether you're bullish or bearish on anything, and with that, you're getting that exposure. Typically, we tend to be more option buyers in the long-term portfolio and use it with just a small amount of money. So that way, you're getting your exposure to the overseas currencies or to the U.S. dollar, depending on what your sentiment actually is. With that, in past webinars, we've discussed it as a hedge for the long-term portfolio. Today, what we're really going to discuss is how straddles and strangles on the currencies can be of benefit to you in more of the short-term section of your portfolio. The straddle and the strangle are the strategies of the day, so to speak. That's what we're going to be going through. Let's start out with the long straddle as we do this. Now, what you're looking at over on the right, these are screenshots from the Brokers Express website showing you what the risk-reward is. A long straddle is when a call and a put are bought on the same underlying for the same expiration. So just as an example, what we're looking at on here is YUK. Yuck. This is actually, everyone always jokes and says that this is my favorite underlying in all of trading. Yuck. I want to trade yuck today. So with that, that is the Japanese yen. And if you were to buy a call on YUK, that means that you believe, and let's assume that you're trading direction only, that means that you believe that the U.S. dollar is going to increase against the Japanese yen. If you bought just a put on YUK, that means that you believe that the Japanese yen is going to increase against the U.S. dollar. So this is a dollar-based underlying with which I'm demonstrating right now. In this case, we don't know where it's going to go, so to speak, so we buy a straddle. Now, does that mean that if you don't know what to do, buy a straddle? Absolutely not. There's a lot of risk involved in doing that, with which we'll address. But let's say, for example, we decide that we want to buy a call and a put on this. You can see what the risk-reward of the trade is graphically. If it doesn't move, and the price with which we bought it was $91.50, was the strike price, the worst-case scenario on this trade is if at expiration we hold the options until expiration, and YUK is at $91.50 right at expiration. If that's the case, that is bad for us with this specific trade. That means that the $91.50 call will expire worthless, as well as the $91.50 put. That's the absolute worst-case scenario with which needs to be respected when doing this trade. Now, the good news about it is that it's a limited risk trade. I just randomly entered in a 10 lot on here. This may or may not be appropriate for how much money you have in your account. You can do a 1 lot. It would be a tenth of the risk. But for 10 contracts, the most you can mathematically possibly lose on this is $5,610. And in our case, at $1.50 a contract, add another $30 in there for commissions. So with this is a limited risk trade. And if you were to do this exact trade with 1 contract, divide that by 10. The commission would be the same in our case for this for a 1 lot. But with that being said, the concept is that you don't have a margin call to worry about. You don't have to wake up one day and see your account balance in parentheses and be scared that the margin department's going to be calling you or anything like that. This is a limited risk trade. That is the beauty of it.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.